Ladies and gentlemen, now that we have gained an understanding of the general sectoral view, it's time to get into the specifics and further understand which sectors will play out in this decade and which sectors will lag behind. To put things into perspective, our panel discussion is going to discuss the theme, will defensives and consumer businesses, in fact, continue to compound irrespective of high valuations, or will cyclicals and industrials create more wealth? Now, to answer these questions, ladies and gentlemen, we have an eminent set of panelists amongst us. We have with us Mr. Hiren Ved and Mr. Vikas Khemani, and of course, Mr. Saurabh Patwa, who's going to be moderating the session. I would also like to inform all of you that Mr. Anup Maheshwari, the CIO at IIFL Asset Management, was also going to be an integral part of this session. However, due to an unforeseen circumstance, him losing a family member, he had to be at the rituals, so he could not make it to this event. Moving on, Mr. Hiren Ved, ladies and gentlemen, let me take the privilege of introducing him first. He's the co-founder and CIO of Alchemy Capital. He started his career by working with KR Choksey and Company, a sell-side firm known for its value investment approach, and eventually graduated to becoming the firm's head of research. He brings over 2 decades of experience in bottom-up stock picking, managing portfolios, and managing a high-performance investment team, which is capable of delivering consistent and superior alpha. A very warm welcome to you, sir.
Thank you so much.
We have with us Mr. Vikas Khemani, the founder of Carnelian Asset Advisors, and has 23 years of capital markets experience, most recently as the CEO of Edelweiss Securities Limited, where he spent 17 years incubating and building several businesses to leadership positions, including institutional equities and equity research. With a strong business acumen and deep understanding of the capital markets, he enjoys a strong relationship with the corporate India and is associated with several industry bodies and committees as well. A very warm welcome to you, Mr. Khemani.
Thank you very much.
And ladies and gentlemen, I'd like to inform all of you that this session will be moderated by Mr. Saurabh Patwa, who heads the research team at Quest Investment Advisors. He has over 16 years of experience in equity research and strategy. And prior to joining Quest, he worked with HDFC Mutual Fund as part of equity research and strategy team. Academically, he's a chartered accountant, ladies and gentlemen, and a BCom honors graduate from Jodhpur, JNBU. Now, once again, I'd like to extend a very warm welcome to our eminent panelists, Mr. Hiren Ved and Mr. Vikas Khemani. And I, ladies and gentlemen, would urge you to pay a lot of attention to this session because these two are exemplary, phenomenal speakers that we have got for this session. I'm going to request Mr. Saurabh Patwa to now take over the proceedings and moderate this session. Mr. Patwa, over to you.
Thanks, Aishwarya. Thanks, and welcome, Hiren and Vikas. It will be a privilege hosting this session with you guys. So good afternoon, everyone. We're here to discuss one of the most important and also one of the most frequently discussed questions, especially in the Indian context, whether one should stick to defensives and other consumer-centric businesses given low penetration, but which have done exceedingly well. And because of the same reason, they are traded at a very high valuations, or trade to other industrials and other cyclicals on back of improving capex cycle, and also the fact that they're also trading at relatively reasonable valuations. However, as we all know, like cyclicals are inevitable as well as unpredictable. So, given that context, what should one do? Whether one should buy and hold, buy more and hold defensives, or move to figure out where we stand in the cycle and accordingly take action. So, without wasting more time, I would like to have thoughts of Mr. Vikas and Mr. Hiren to help us solve this puzzle. So I would request Mr. Hiren to first give his opening comments on given that context.
So thanks, Saurabh. I often find this debate very interesting, that whether you should be buying, consumer businesses which are considered to be more defensive versus more cyclical businesses, so on and so forth, right?
Yeah.
I think there are 2 aspects to this, right? I think one is that every investor or manager, right, has a certain circle of competence, right? Um, for example, there may be some investors who say that, look, I don't understand cyclicals. I don't understand deep cyclicals, right? Even within cyclicals, it's not a homogeneous, universe of companies, right? In many senses, every industry is cyclical to that extent, right? And therefore, to label just the consumer businesses as defensive and everything which is industrials and commodities as cyclical, uh, you know from a point of view of generalization, it is good, but when it comes to investing, right, it's much more complex. So one, as I said, is your circle of competence. So you do what you understand best, and you can probably optimize the way you want to manage the risk in your portfolio, take advantage of the opportunities in that manner. Secondly, it's not either or. Okay, I think it is and it really depends on how you build your portfolio or how you allocate your investments across several opportunities. So let me give you an example. So in the very traditional context, what happens is that we talk about, for example, IT services companies is also defensive. Now, we've called IT service companies as defensive in the past because whenever global macro has been tough, it has impacted our currency. A currency weakening actually helps exporters. And these companies are high return on capital. They are free cash flow positive. They don't have working capital issues, right? And therefore, they end up becoming defensives, right? Today, in the current context, I would actually call IT service companies as a growth sector, not a defensive sector, right? Because where we are in the tech spending cycle, these companies are seeing a structural tailwind in terms of growth. And the market, valuations are a function, in my opinion, of a tripod, right? So think of a stool with three legs, right? Growth, return on capital, and the runway for growth, right? The visibility for growth, right? So how long a runway for growth do you have? Or with reasonable predictability, how long do you think that you will have a big runway for growth, right? And I think the market shifts in terms of, these three tripods, right? So I think that so let's take defensives, and generally we say that consumer businesses, defensives have a very high valuation, right? And the reason is that their cash flows are very predictable, relatively speaking, right? The volatility in earnings is far lower, right? And generally, these businesses have had high return on capital. So if you run a series of data over 10, 20 years, you will find that the best combination that you can have is that the market is willing to give a higher PE to companies which have high growth and high ROE at the same time. So if you have a business which is, let's say, compounding at 30% with a very high ROE, right, the market is willing to give you a high PE, right? So let's take an example. It's not a consumer business, but let's take Bajaj Finance, for example, right? Bajaj Finance stock price has compounded at 50% a year for the last 10 years, right? Because it had two things. It had, the book was compounding at 35-40% a year, and ROEs were in excess of 20%. So you had a great combination of within the financial services space. Having a ROE in excess of 18% is great. It's like an FMCG business having an ROC of greater than 30%, right?
Yeah.
So if you have a business which has high growth and high ROE, the market is willing to give you a high PE, irrespective of what is happening at a macro level in the markets, right? Similarly, I have also seen when you talk of typical FMCG businesses where the growth rate is much more moderate, right? But the ROEs are higher. Even then, the market is willing to some extent, make do with higher valuations because there is no reinvestment need, right? And typically these companies also pay out a large part of their profits, right? So if they pay out a large part of their cash flows, and even if the growth is moderate, then I would say that the second in the pecking order would be that you will see that the market is willing to still, do with slightly higher valuations, right? Now, what happens is that typically, if you take the first example, where the ROE remains great but growth tails off, then you will see valuations contract, right? Now, coming to cyclicals, right? In cyclicals, I think it depends on where you are in the cycle, right? If you are in the early stages of the cycle, looking at P's or value, P's may not be the right thing. Maybe you got to look at price to book, or you got to look at that typically during a good cycle, what is the average valuation that the market is willing to give you, whether on an EV/EBITDA basis or a price to book basis, right? And then you decide where you are in the cycle, and then you decide whether what valuation you are willing to pay for it, right? And there the price is more sensitive to if you're looking at a commodity kind of business like metals, right? I mean, even if in the cycle the return on capital is very good, but metal stock prices are very sensitive to end commodity prices, right? So you can see even in a bull market cycle of metals, you could see 30-40% drawdown because the volatility of earnings is very high, and therefore these businesses relatively get a lower valuation, right? So I think therefore, in my view, you can't therefore compare in that sense apples and oranges, and it is not about only an apple and an orange. Okay, your portfolio is like a fruit basket. You decide how much of what combination are you okay to deal with, right? So I think that the way where we are standing today, I think that if you look at incremental returns from here onwards, I think there are several sectors where we are in the early stages of a cycle. And therefore, if you take a medium-term view, my view is that, yes, there is an opportunity that on a risk-adjusted basis, you can still probably make slightly higher returns in cyclicals than you would have seen with the so-called high-quality defensive sectors. And the market's already rewarded those sectors, over the last couple of years. And therefore, my view is that there is opportunities both ways, and it depends on the objective with which you are building your portfolio or you are making your investment, right? So that's my broad top-down view. I'm happy to then engage at a much deeper level, and I'll kind of let Vikas also give his views on this.
Yeah, over to Vikas. I think Hiren has put it very wonderfully, the whole part of the puzzle in a very wonderful way. I would urge you to add on or give your thoughts so that we can come even more closer to the.
Yes, I think anyway, Hiren has dealt this subject in a great way and great thoughts. So the way I think is again is that actually speaking, everything is cyclical. There are cycles in everything in life, right?
Right.
Some cycles are long cycles, some cycles are short-lived cycles, right? Longer the cycles are, predictability becomes little easier. Shorter the cycles are, they become slightly, harder and difficult, right? I mean, if you go back and see, today what we are considering so-called high-quality defensive cyclicals, consumer plays, whole of 90s, or I would say even whole of early 2000, from 2000 to 2007, 8, they were trading either single digit or mid-teens kind of multiples, right?
Yeah.
I remember till 2007 is, I think probably Hindustan Lever from 2001 to 7, 8, it delivered almost zero return, right?
Absolutely.
So essentially, it is important, and that was true with a lot of stocks, right? So essentially, everything is a cycle. We saw extended cycle of IT services, for a period of in mid 90s to late 90s and early 2000s, and then it again went into a negative territory, and it kind of became from high growth stock to sector to no defensive sector, and went nowhere for long. And then if you see last 2 years post pandemic, it has suddenly become a high growth sector. So to me, the key important aspect is that how far you are able to predict the growth of a particular sector, and within that sector, of course, a particular company. So ultimately, I personally believe that whether it is sector or company, markets are slave of growth, right? Number one, and like Hiren also said, the growth, and secondly, the return ratios, right? I would add only one thing, or probably to that, the third thing. So growth, return ratios, and longevity or sustainability of that growth, right? How easily you can predict, or how far you can predict that growth, acceleration in that growth, and when it some point in time. So whenever there is growth with a decent return ratios and acceleration happens, you will always see a fine phase of P re-rating. That time sector will go from low earnings. So if a sector is coming out from let's say low growth environment, low valuation environment, which let's say today FMCG was in, let's say 2008-9 period, when it came out of the low growth environment, and suddenly because of Manrega and a lot of things, demand environment in rural India picked up, and we saw sectors, so earnings growth, and thereby followed by a re-rating. And post that period, you see a high growth phase, and then growth plateaus, and then kind of slows down. And as that phase hits you, then it kind of tends to decelerate. The de-rating happens, de-rating takes place. Look at, FMCG sector, if you see 1 year, 3 year, 5 year average you take, in last 2 years, FMCG delivered less than 10% total return. 5 year return average is also single digit return, the entire index level, right? Now it is clearly showing you what kind of returns it is offering, right? So it is in that kind of, despite, so if you are looking at to invest into where your capital loss may not happen given the nature of the businesses, which is very solid, stable, high moat, less sort of volatility, then, and potentially probably loss less return, of course that's the place you can park yourself. So it really boils down to your risk appetite. Same way metals, which are otherwise in a deep dump pre-pandemic or during the pandemic, as the demand environment changed for them, we saw how the whole sort of re-rating took place. Capital goods sector last 10 years pre-pandemic has been in doldrums, because in India there was hardly, demand cycle was kind of in a very, very bad shape. We didn't have capex intensity at all, and most of the capital goods sector did not go for a whole decade, right? And the moment you saw today the drivers of the capex coming into play, most of the stocks have got re-rated ahead of even earnings delivery. And why that so? Because today the faith of market in the drivers of the capex cycle, in the drivers of the earnings growth of those capex oriented company is far higher, of course, rightfully, because there are lots of drivers which are kind of taking place. So we will see now if this cycle, and this is coming after long dull of 10 years. Will it last over next 5-7 years? Answer is very much yes, right? Now, if you are, let us say, looking to play this cycle out, you can obviously go and play sector leaders within that. Now, even the sector leaders within that, high quality players would be sort of offering bit of a defensive and bit of a good growth both, right? So at least as far as I am concerned, generally, I personally believe that large part of the effort, again, it requires a lot of knowledge, effort, deep understanding of each sector, various demand drivers, cycle, demand drivers. And if you are able to find that out, you can make supernormal return, in early to mid or little late stage of the cycle. Large part of the return of any cycle, and I would say, whether it is short-term cyclical or long cycle, is made from early cycle to mid to little late stage of the cycle. After that, it is probably in a sort of slowdown or sort of deceleration phase. And same way I can say, let's say for banking, typical cycle we have seen, high NPAs, then provisioning happens, capitalization happens, and then low credit growth has happened, and the credit growth picks up, accelerates, valuation re-rating happens, and again it goes to a high NPA cycle. We have seen this cycle playing out so many times, right?
Yeah.
So
Yeah.
now whether banking is a defensive sector or a cyclical sector, one can figure out. So I personally think that everything else, everything in life has cycle. Even companies have life cycle, cycles within their lives, right?
Right.
So,
Right.
so I think the key thing is to figure out, of course, the broader macro trend which is going to driving the demand for the sector, and then within that you have to, of course, understand the company, their return ratios, growth. According to me, markets are slaves of growth, and higher the growth, it will be rewarded well by the market, and returns are to be. So that's how I think at least we try to build a portfolio where at least 50-60% of the portfolio which is capturing the accelerating growth, which is what we call in our portfolio magic basket, and then about 30-40% we capture where there's a stable growth, where 15-18% kind of growth you can capture, so that it gives you balance kind of accelerated return as well as a stable return.
Fair enough. So there's one more thing which I would want your thoughts on, here in yours as well, on like the impact of inflation on cyclical as well as defensive, especially when we see that the consumer companies have a better ability to pass on the prices versus the smaller players, and this helps them to gain market share, as well as we have seen in the current quarter as well as in the past also whenever the inflationary times were there. So does that make them a better play, especially in the context of inflation versus a cyclical where if you the probability of you getting in the wrong point of inflation can be a risk?
Look, I think again, it would be tough to generalize, right? So if you look at the third quarter numbers, you are seeing that inflation in raw material prices is hitting both the cyclical sectors as well as what we call as the defensive sectors. So defensive sectors, whether it is paints or FMCG, whatever it is, I think their raw material prices are going up, and they are all, it's a myth in many senses to say that defensive sectors are better able to withstand inflation, because there is a limit. It also depends on the extent of inflation, right? You cannot suddenly, if your raw material prices go up by 30-40%, it's very difficult to pass on everything in a single go. So it may take time before you are able to pass it on, right? But again, it depends on the competitive intensity. Okay, so when you are looking at inflation for any sector, cyclical or defensive, right, it depends on the competitive intensity of the business, right, and whether price points matter or not in that industry, right? And therefore, if you look at a defensive sector, you will see that if the competitive intensity is very, very high, then you may have a player who may, to gain market share, may in such a scenario play a price game. So they may not increase prices because their objective is to take away market share, right? And therefore the entire sector may not do well because they are, because of the competitive intensity, you are not able to increase prices, right? Secondly, it also depends on whether you are, in many cases, a B2B business versus a B2C business, right? Sometimes if you are a business where which happens in ancillaries many times, right? That eventually the OE gives you a price hike, but you may not get all the price hike. He may say that you can you have to get some of it through productivity gains as well, right? In the classic scenario, let's say in the current phase, if you see, IT companies are seeing are seeing inflation in wage costs, right?
Yeah.
But there is it's not that the competitive intensity is very intense today, right? And therefore they have many more margin levers to take care of wage hikes, right? Now, obviously, some of the bigger companies are able to manage it better than the smaller companies, right? Because they have several more margin levers as opposed to, let's say, an auto ancillary who might take many more quarters to pass on the entire price hike to the end customer, right? So I think inflation does impact profitability. Inflation and eventually interest rates may also impact valuations to some extent, right? We've seen the benefit of low interest rate on valuation. So all FMCG stocks, which used to be at 40, 50 P, that entire curve went up. And, today many of these companies are 50, 70, 80 P stocks, right?
Yeah.
So I think that, again, I would love to give a very straightforward answer to this.
Yeah.
But, I think that where you are in the cycle, what is the competitive intensity of the business will impact inflation differently for each companies, right?
Yeah.
So I think that is so. For example, if a large part of your volume, so let's say even though Parle is not listed, if you take biscuits as an example, right?
Yeah.
I mean, there is huge volumes, but it's a price sensitive market. The 5 rupee pack, right?
Yeah.
Now suddenly, if you make the 5 rupee pack a 7 rupee pack, right? Volumes may just fall off.
True.
Though it may be, you can say that it's an FMCG business, right? So sometimes, what price point at which you have the volume price trade-off is very different. It's very difficult to generalize that. But yes, I mean, in general, if you are in a business which has more pricing power, your brand is strong enough that you can take, pricing, and there is relatively less trade-off between pricing and volume, then those businesses obviously will do very well. Actually, inflation helps some of these cyclical sectors like commodities, right? Because rising prices actually help you to make money, right? Or even where your value addition is tagged to the end price. So let's say jewelry, gold jewelry, right? So if you see, a company like Titan will actually do very well on profitability in slightly, not very steep, but in slightly rising gold prices, because making charges are a percentage of your gold prices, right? So to some extent, there is leverage to profitability in rising commodity prices. So again, as I said, you have to look at each sector. You have to look at the competitive intensity of the sector, and then you can probably understand the impact that inflation can have on each of these sectors.
So, Vikas, anything which you would want to add in this context, as you previously highlighted that there has to be a balance and in the portfolio. So, in the current context, would you want to move away from your traditional weightages to a slightly favoring a cyclical like a commodity, or move to more of a consumer, which is a leader, as you have earlier highlighted?
So I think in the current context, again, we look at slightly long-term mega cycle, and we've been kind of the view that we right now are witnessing 3-4 mega cycles, or mega big long-term cycles, so to say, and which are not typically the short-term cyclicals and commodity plays, because their predictability becomes difficult, and especially when you are already in the mid of the cycle. You are passing the best phase of the returns, and then you are kind of only looking for a smaller rest of return over the next 4-5 years, maybe a compounding kind of return. So if I were to look at the big money is made when you can identify some mega trend, real big cycles, 10-year cycle, 8-year cycle, right? And if you get that right, I think you are kind of by and large home. So in that context, one of the we are in the middle of a very big mega cycle, I call in form of manufacturing, right? which I think started post-pandemic, due to, of course, government's focus on Atmanirbhar Bharat, as well as I think additional significant catalyst where China Plus One is kicking out in a big way, right? Now, these are so structural, big trends that over next 10 years, many companies which we are seeing today, which are present in manufacturing, it is manufacturing a general word, but across various sectors where India has an advantage, whether it's auto component, APIs, chemicals, capital goods, many of those, even toy manufacturing, many of those which are basically, leveraged to this whole Atmanirbhar Bharat as well as China Plus One strategy. You will see a 10-year mega trend, and in that you will see companies becoming 10x, 20x, 30x kind of thing, right? And that is so if you get this right, and we think that that big mega cycle has just started, right? It is pretty much similar to, probably you can call it, a Y2K moment, what was there for IT industry in early 90s, which lasted, and this is just the beginning of a, so if you kind of put some money here, we are kind of significantly leveraged on this, in terms of we have specific product for this also, but in our all funds we have big exposure to that. And we think that it's and all these companies will be in accelerated phase, earning phase, and and there's a tailwind, and then you go and identify sector leader in that. So this is a very big cycle. That's how we are positioned. Second one, if you see again, that we are in a big technology sort of cycle as well. Post pandemic, every company needs to spend money on digitization, cloud migration, and we all know that in our lives there's more of technology, whether it is enterprise or individuals, and more spend is going to happen. So demand is sort of global, but the supply is only Indian IT services, and the competitive intensity is very, very low in that. Only kind of meaningful 10 companies which provides this work, right? So you have 10, 12 companies supplying, and demand is global. Now you can kind of contextualize that what kind of cycle we can be in over next 5-7 years, and what kind of wealth can get created. Of course, there will be sort of short-term challenges in the correction, but it's a mega cycle according to us, and this is a very, very big change. Thirdly, I think if you see, we are just coming out of a long poor banking cycle, right? I mean, we had a high NPA, post ILFS crisis, everything went for a tizzy, and then I think we had provisioning, capitalization, then pandemic related issues. Now we are in a situation where our banking sector is fully provided, well capitalized. More importantly, our soft infrastructure, enabling infrastructure in form of CIBIL, which was not there in the previous cycle of 2007-8, when all the retail loans went into difficulty. And we have now IBC, which is again enabling infrastructure for having a robust credit profile, which was not there in the previous credit cycle of 2009 to 14, which eventually led to create a lot of problems. So we have a well-geared banking sector enabled by two basic enablers of the growth, and so these two will make sure that we don't have a massive another NPA cycle ahead of us. And we are on the cusp of beginning on a aggressive, on the cusp of a growth cycle on the credit side. So I feel over next 5-7 years, Indian banking and financial services sector in general can kind of deliver significant sort of returns to investors, and in a very solid manner. I think, in my opinion, banking will be looked at very differently in this cycle because of this enabling infrastructure, which I mentioned. And lastly, I would say that one sector which has been ignored, over last 10 years, 15 years, whatever, and for many reasons, is real estate. We never had strong regulatory framework for real estate ever, right? Post RERA implementation, we had some challenges. I think we had challenges of the financial sector and challenges of the real estate sector. We are behind that. So here is another sector where and I always say that whenever there's a strong regulatory framework and a big sector with a big demand, it goes through in a mega trend. Like capital markets became a very big trend post formation of SEBI. Of course, SEBI got formed in 1992. But if you see what happened, all of us are product of capital, SEBI formation. Over 20-25 years, we have created a massive industry, right? Same way, real estate is a very large sector, strong demand, and now we have a strong regulatory framework. So here now market is consolidating, larger players are becoming bigger and bigger, and demand is going to be strong. And right today, specifically even short term, there's an advantage where there's a short term, supply shortage, and the demand is picking up because of job creation in the economy. So if India has to happen, we will be, I can tell you, next 10 years, we'll be surprised how many large real estate players would be there. So if the point I'm trying to tell you is that if you identify these 3-4 mega cycles, and can be sitting in the middle of it,
Yeah.
then you can peacefully write. And of course, you have to identify a company with high governance and solid frameworks and all. Then you can kind of write and create massive wealth on this, and that is what at least our advice to investors is.
Thanks. It was very brilliantly put, Vikas. As we're coming closer to our session, I would want your thoughts also. There is a new set of companies which have got listed in last few months, where the opportunity size seems to be very, very large. And that's why the growth trajectory also seems to be very high. But the profitability doesn't seem to be in the picture, at least in near term. So, and these business models are evolving. They're moving to newer locations, moving to tier 2, tier 3, and beyond, and so on. And but valuation of these companies becomes extremely difficult. In many cases, even just to be closer to that, you have to take a very long DCF kind of evaluation, and that's where you can come to some conclusion. Whereas getting year-to-year numbers is extremely difficult. So, how would you look at these companies? Yeah.
So I
Hiren, you may start and then Vikas, you may conclude that.
Please. Okay.
So again, right? I mean, the new age or the new internet companies. There are many names and nomenclature that people use now, right? I think they are not. Again, very homogeneous, though we may like to all club them into one basic group. But I think that the investors today need to have a very long view. And secondly, when cash flows and profitability are not visible in the near term, right?
Yeah.
These companies, in my view, will go through massive bouts of volatility and drawdowns, right?
Yeah.
And therefore, while the growth is there are phases in the market when market gets very much concerned about cash flows and profitability. And therefore, investors have to be very clear that if you want to play these hyper growth long-term companies, right, you have to live with intermittent volatility. Secondly, I do agree that when you invest in these businesses, the starting valuation is very, very important, right? And therefore, my view has been that the current FOMO that a lot of investors have to be part of this new age companies is misplaced, because the best of companies, if you go back and look at the charts of some of the best global tech companies like Amazon, Google, right, Facebook, in their life cycle, where, while they were, companies which were very innovative and trailblazing, and they came up with new products and services and virtually captured not just the American market, but the global market. But in a 10-year cycle, you had several opportunities where these businesses were available at a very attractive valuation, where all these risks were at some point in time priced in, right? So I think that it requires, I think that investors should either be very clear how much they want to allocate. In my opinion, there is no love lost even if you do not participate in the initial phase, or if you do wish to, I think you better do it through people who have the ability to understand, size these positions, and then make an entry at the right time, right? I mean, like, a few years ago, Chinese tech, you could go no wrong. And then with the regulatory overhang today, the best of these companies, you are able to get it, at 50-60% lower prices, right? So I think that this is this entire cohort of companies have a huge opportunity and runway, but the path to nirvana is very rocky.
Yeah, yes, your thoughts.
My thoughts again, pretty much similar to kind of Hiren, and I've said, in many media platforms and all. I've also played a role as an investment banker, right? So, if you go and see today, most investors are, acting out of there's a fade, of course, and out of FOMO, right? And whenever such kind of things happen, and outcomes are always kind of not so good, if you ask me. Most of the companies which are going public, or I mean, many of them are very, very good franchise. They will become big over a period of time. But I would say today, what kind of company which are hitting market under the garb of new age, I would believe that in next 5 years, 50% of them won't be around. Go back and look at what happened to companies which went public in 99 to 2000 cycle, where the valuations were based on a per eyeball and whatnot. Same thing, in 2005 to 7 cycle, when the infra companies went public based on order book multiples, or real estate. You buy the land and create the real estate book, and future 10 years profitability, and then discount that for the land which does not even exist. So point is that we have seen all those kind of cycles, but when the sanity prevails, all those things kind of disappear, right? And we don't see many of those companies even around today. Not even, I mean, they've destroyed 100% value, right? So I'm quite confident that many of these companies will destroy that value today also. So hence one has to be very, very careful in what to buy, when to buy, not to buy when everybody is buying, not to buy because there's a fashion to buy. You get a bragging right in party to say I own XYZ company, and I kind of, so you might make money in shorter term, but and you have to live through, like Hiren was saying, through the multiple drawdowns. The important thing to understand whether the business has a moat or not. Is it really addressing a problem? Unit level economics are there or not? Is it replaceable? Today a platform like Zomato may not be replaceable, right? But do I really buy Zomato at when everybody wants to buy, or do I want, because there will be phase, and we have seen this, right? That we have seen it's correcting, and maybe it can correct further also, right? So you should buy these companies when probably that fashion or fade is faded, is gone away, and then I think so. And other than that, I think if there's specific money, and many of these companies will become very large, I can tell you, because whenever there's a disruption happens, whenever there's a new change happens, new companies will come out of that. A Bajaj Finance will come out of this kind of transition. But idea is to kind of, do you have the ability to identify those kind of companies? That is the real critical, not to kind of read in the newspaper and say this is looking interesting, and hence, or when everybody's being part of it, I should be part of it. So it's a very risky strategy, and one has to be very, very sort of careful. And right now, at least, I would strongly suggest to avoid this FOMO where everybody wants to be part of it.
With those wonderful words of wisdom, I would like to thanks to Hiren and Vikas. It was wonderful hearing your thoughts on the content, and I'm sure everybody else, whosoever had was there on the call and whosoever will see this video going forward, also would enjoy hearing these thoughts. Thanks a lot, Hiren. Thanks a lot, Vikas. Over to you.
Pleasure to be chatting with you. Thank you very much.
Thanks.